Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA Podcast Series, and today's guest is Mark Minervini. According to Minervini, we are not forecasters, we are interpreters. Mark Minervini is one of America's most successful stock traders and a veteran of Wall Street for nearly 30 years. To demonstrate the capabilities of his SEPA methodologies, in 1997, Minervini put up $250,000 of his own money and entered the U.S. Investing Championship. Trading against stocks, futures, and option traders, he traded a long-only stock portfolio to win the real money investment derby with a 155% annual return, a performance that was nearly double the next nearest competing money manager. Minervini is featured in Jack Schwager's Stock Market Wizards, Conversation with America's Top Stock Traders. Schwager wrote, Minervini's performance has been nothing short of astounding. Most traders and money managers would be delighted to have Minervini's worst year, 120% gain, as their best. Minervini has been a regular featured guest on CNBC, CNN, Bloomberg Television, and Fox News. In 2013, Minervini published Trade Like a Stock Market Wizard, How to Achieve Super Performance in Stocks in Any Market. Welcome to the program, Mark.
Thanks for having me.
Well, tell me about your background. How did you become interested in the financial market?
Well, my background has nothing to do with the financial markets. I quit school at a very young age and grew up relatively poor, and I always wanted to be able to have financial freedom and personal freedom. So I started trading in the early 80s with a very small amount of money. Incidentally, my original approach, or lack of strategy, if you would say, was doing the exact opposite of what I ultimately ended up doing that gave me my success.
So how did you get your feet wet? Did you just start trading and figured out what didn't work? And is that how you got to what did work?
Well, back in the 80s, there wasn't as much information that's available nowadays, where you have online and you have some great resources with social media. Yeah, you had to do a lot of trial and error. I spent a lot of time in libraries, and it took about 7 years, 6 or 7 years, before I was able to really even turn myself profitable. So it was a long road for quite some time before I was able to really get the hang of trading and become consistently profitable.
How would you describe your style of trading?
My style is one that combines technicals and fundamentals. I like to take all the data that I can and utilize it. I look at the individual stocks first, as opposed to taking a macro approach and then moving to the stocks by moving to the groups. What we found is when you're trying to get the leading stocks in the market, that by the time some of the groups are hot or really apparent of what groups are doing well, the best names in the group have already taken off and made big moves. So I would describe it more as a bottom-up approach.
You have something that you call the SEPA strategy, specific entry point analysis. Can you tell me what the components are in your strategy?
Well, there's a few things. The trend of the stock is important. We're looking for continuations of existing trends that's backed by some fundamental catalyst, and then we're looking for very specific entry points, as the name would lead you to believe. When I started trading, I had a very small amount of money, and I really couldn't afford to lose it because it was all I had. So precision was very important, and I worked very hard at finding when to get into a stock just before it was about to start moving, so I didn't sit with dead money. And I had to make very large returns on that small amount of money to really turn it into anything worthwhile. So I wanted to increase the effects of compounding. So I try to get into a name that's going to move very quickly either positive or negative. If it moves in my direction, great. If it doesn't, I'll at least want to know that I'm wrong very quickly, so then I could redeploy the money somewhere else and compound it.
So that approach seems very intuitive. I think of a quote that William O'Neill of Investors Business Daily says that diversification is a hedge for ignorance. Do you agree with that comment?
Well, if you're looking to make big returns consistently, you're not going to make big returns on a consistent basis if you're spread out all over the place and you're overly diversified. So I would agree with that if that's your goal. Also, you really can't know a lot about many different companies, so it's better off to have a smaller number of names and be able to watch them more closely. If you're on top of them and you're using stop loss protection, and you're not letting the losses get too out of control, then you should be able to own a handful of names, and maybe 4 or 5 names for a small or medium-sized portfolio, maybe 8 to 12 names for a larger portfolio. But I certainly wouldn't suggest that you own any more than 15 or 20 names maximum.
So let's talk about it in practice. Your initial technical screen of stocks may get you down to, say, 200 names. And then your fundamental screen would get you down to, say, 20 names to watch. If you wanted to get down to 4 to 5 names, how do you get into the stocks? Do you just take the first 5 that make a move? How do you determine the market leader? And how do you rotate your portfolio? Because I would think when the market is moving, you're going to get a lot of buy signals. So how do you get from that, assuming you had a basket of 20, how do you get the 20 down to the handful of stocks that you're talking about?
Right. Well, when I first started trading, I would tend to have favorites for whatever reason. Usually it was for reasons that weren't as important to what makes stocks move as it is to maybe what was just my own personal peeve. I might like the product, or maybe I read an article on it or something. And then I would sit there and wait for one of these stocks to emerge. Meanwhile, a whole bunch of other names were emerging and taking off. And what I ended up deciding and realizing is that you let the market tell you where to put the money in. And usually the ones that move first are your best candidates when you're coming off of a correction. I like to buy new emerging names in the leadership space after a correction. So when you're coming off of a correction, you start to run up off the lows. The ones that start breaking out of bases and coming out of consolidations, the very first ones that emerge, those are the ones you want to try to get on board. So I'll use basically a forced displacement. If I have 10 names and I'm setting some alerts as to where it's going to be my entry points, the ones that hit those alerts first are the ones that are going to go in the portfolio first.
And how do you rotate the portfolio? Do you hang on to those first names until they stop you out and you ignore all the other buy signals?
Well, yeah. Well, of course, on the downside, if something stops me out at a loss, then of course I'm going to then look to redeploy it into maybe something else that's moving. However, if I were to get stopped out repeatedly over and over, I would take pause at going back into heavily. I'd probably pull my exposure back a little bit, just maybe move into a few names. So that's very fundamental to my management of risk. Is that if things are working, I'll step up the exposure and I'll step up my my activity. If things aren't working very well, I'll pull back. But another thing is sometimes the best stock that you could buy is one that you're already holding. So you don't necessarily want to just look for new ideas just for the sake of it. You might already be buying into a key market leader coming off of a correction, and you've already got a tiger by the tail, and maybe you're at a pretty good gain in the short term. But if you're just starting a new bull market and you're buying some of the very first stocks to emerge, you should try to give them some room to make a bigger gain for you than just taking a short-term profit, as opposed to being maybe later stage in the market where maybe the market's been running up for a number of years. At that point, you might switch over to a little more of a trading type of style.
Let's talk about your trading championships. You won a trading championship in 1997, and you were winning another one prior to that was suspended. What does it take to win a trading championship?
Well, in 1997, it took 155% annual return on my account to win. That's what I ended up returning for the year. It took a lot of discipline and sticking with my strategy throughout the year because I wasn't in the lead for the first 6 months or so. It wasn't, I think, until the third quarter when I was about tied for the lead, and then at the end, I pulled away when the market rolled over, and I actually made money, and most of the rest of the field, their returns got smaller. So I was pretty confident that if I stayed with my plan throughout the year, that I would end up finishing at the top tier. I wasn't absolutely certain I would win it, but I thought I had a good shot.
Some money managers, they're not only competing against absolute performance, but they're competing against the guy across the street. And if the guy across the street is taking unusual risk and getting rewarded for it, there's that pressure for you to take unusual risk as well. Were you feeling that pressure since you knew you weren't leading for the first part of that competition?
Well, I think that's an excellent point, and I was definitely feeling the pressure when I was behind, particularly in the very first quarter. I think I was up like 8%, and the next guy was up like 40-something%. So I was immediately saying to myself, "Wow, these guys are getting big returns right away here." But it took, I really believed in my strategy, and I made a decision that I was going to stick with it throughout the entire year, regardless of what happened. I didn't want to go in and start calling an audible in the middle of the year. I wanted to give my plan a chance, and I just stayed with my strategy and my plan throughout the entire year. I think of the year as kind of a 12-inning game, where if I don't start off good in January or February, that's okay. I still have the rest of the year. So I try to get my rhythm in the beginning of the year and just make sure that I don't get underwater, and then as the year goes on, start keying in on themes and increasing my activity.
And when you think back of all your trading, is there a particular trade that stands out that you're particularly fond of?
Well, I would say fond of. I have, well, the one that sticks out most in my mind, and it's ironic too because we're just celebrating or actually mourning the 9/11 situation. I was short going into 9/11, so I was short the ETFs on the overall market. So it was sort of a it was a very mixed feeling when 9/11 happened. I knew that I was going to make a ton of money when the market opened, but I felt horrible about it. So it was that definitely is the most memorable trade without a doubt.
Right, because memory serves, the market's closed for, was it 3 days? And then when they opened, they gapped down. That's what my memory. I'd have to go back and look.
Yeah, I don't remember how many days actually it was closed for. I thought it was several days or a week, and then of course it gapped down, very big gap down when it reopened.
Did you? The market bottomed within a week of that, I want to say. Were you able to cover your short position in time?
Yeah, I think I actually covered on the open. I just got out on the open. Yeah, and it was one of my big profits of the year. I had a pretty good size short position. The market had been rolling over already, and ironically, the the only stocks that were setting up, and I almost went long, the defense sector stocks, which would lead you to believe that there's some intelligence there in the market. But I didn't because the overall market looked so poor that I didn't really want to be long any stock. So I was short the indexes.
What advice would you have for a trader with a small account like you were when you started out?
Well, first of all, you have to find something that is best for your personality, and there's all different ways to skin the cat. Various different strategies. Not necessarily one is the best one. There's more than one way to make good returns in the market, but you need to find something that makes sense to you that you can believe in, and then also you need to make a commitment to it and not give up too early on it, because it takes quite a while to learn how to operate in the market and to learn all you need to know about any particular strategy. So, not giving up and getting discouraged and wanting too much too fast. The main thing is, no matter what strategy you're using, you need to definitely have some type of risk management plan going into your trading and into each trade. So you have to cut your losses at some point, and that's really key to manage the downside.
So I know we don't forecast the markets, we just interpret the markets. So what is your interpretation of the markets today?
Well, things have changed a little bit in the past few weeks. For a while there, it looked like we were going to top out at least on maybe an intermediate term basis, and the Dow actually pulled back a little bit there, and that was based on the Fed starting to talk about tapering and pulling down their bond purchases, and then of course we had the Syria situation. So, and in very short order, the Syria situation didn't turn out to be a situation where we're going to start bombing, and also around the same time we had some weak economic data come out, and I think that has put the Fed in a position that they're still their hands are tied. They're probably going to have to stick with their bond purchases for some time here, and at least if there is going to be any tapering, it's going to be very, very light for the time being until we see stronger economic data. So it's still, the market is being held up by the Fed policy here, and although I think the bull market is late stage and is probably due for some type of correction, it probably won't happen until the economic data comes in strong, which would mean that the Fed would then have to pull back on their printing press.
Okay. Is there anything you would like to add before we go?
No, I think you covered quite a bit here. Like I said, for people just starting out with trading, you want to just don't give up, and that takes time, and be patient, and realize it's going. Anything worth taking an effort at and achieving takes time to learn, and find a strategy that best works for your personality. It might be someone who likes the short-term trade, or maybe you have a different personality that wants a longer-term time horizon. So just find something that works for you.
If somebody wanted to read what you publish, where could they? What is your website?
My website is Minervini.com.
All right. Very good. I appreciate your time today, Mark.
Great. Thanks for having me.
Today's guest has been Mark Minervini, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarak at the MTA, reminding you that price is always right.